The taper tantrum is back in full effect. Freddie Mac is raking it in, and we've got a special guest. You're in the right place, folks, because this is where the money is. All right, Morgan Housel, our special guest, full contributor. I'm going to start off going to you. We've got an article this morning, Wall Street Journal, Market Beat, Stephen Russolillo. We've got the taper talk back in full effect here. The Chicago Fed president, Charles Evans, who's a notorious dove on inflation, has basically said that good improvement in the labor market makes it likely that in September the Fed could start tapering.
Yep.
Is it time to panic?
Well, I think there are a couple things to think about. One, we've been talking about taper
Is
talk.
it time to panic? Come on.
Well,
Yes.
for you maybe. For everyone
Okay.
else, maybe not. A couple of things to think about. We've been talking about taper talk in one form or another for 3 years now. We had QE1, QE2, QE3, QE infinity. All of those have tapered at one time or another. What happened during those times when we had taper during past rounds?
We've panicked all the way along, and
All
it's
the way to
worked
the
out
top.
really
You
well.
maybe, but what's really interesting, I think, if you look at interest rates during the past tapers from QE1 and QE2 when the Fed stopped buying bonds, what happened to interest rates? Common sense tells you interest rates should have gone up, right? The Fed starts buying. Every time the Fed has stopped QE or pulled back from QE, interest rates have dropped. Which is really interesting. One possible explanation for that is that when the Fed pulls back from QE, that's going to hurt the economy, and then growth in the economy is going to slow. That causes investors to go back into Treasury bonds. But I think the overall point is that it's really hard to tell what's going to happen after the Fed starts pulling back.
You're making my head hurt here. So the economy improves, and the Fed threatens it's going to pull out. When the Fed pulls out, then maybe the economy is going to get worse, and so interest rates go down. What can investors do here? What should investors do?
I don't think investors should be paying attention to whether the Fed is going to taper next month. Making investment decisions based on, are we going to have QE5, QE6, are we going to taper in September, or taper in October? Those shouldn't be the kind of things that investors are thinking about when making their investments.
David, you disagree, right? You've always said investors should primarily be focusing on the Fed for their investment
I don't even need to say anything else. He summed up everything I've been saying. Okay, let's think about it this way. Do you think Jeff Bezos, when he was considering purchasing the Washington Post, was like, I don't know, the Fed may taper. I don't know if I should do it or
I don't know
not.
what he was thinking when he was considering.
So,
buying the
I mean,
Washington
again,
Post.
I don't pay too much attention to it. I don't think investors should. And it's also, you have to remember, QE is not the Fed's only tool. Just because they stop buying bonds does not mean interest rates will skyrocket. Like you said, they can also keep short-term rates very low, which they most likely will through 2015, Bernanke has said, I think. So I don't see too big of a deal. I don't think this is something investors should be trying to navigate and really position the portfolio for either one.
Okay, sticking with the Wall Street Journal, we've got an article from Shandy Rice. Bank of America. The Justice Department is suing Bank of America over some mortgage-backed securities. What I found particularly interesting here is that these are homegrown Bank of America securities. This did not come in through Countrywide. Is it finally time for investors to panic and get out of Bank of America?
Well, first I'll note that you said they're homegrown, meaning they're not Countrywide, but they're not truly organic Bank of America. You walk into a branch, get a mortgage from your mortgage lender. I think over 70% of these were from third-party lenders. So Bank of America used to have these third-party lenders that they would take these loans on their books. They have since exited that business. So this isn't something that Bank of America is still doing. And on the side of should they panic, I don't think so. Again, I think I said last week, this isn't news to Brian Moynihan. He didn't wake up and say, oh, what? Mortgages that went bad?
Let's hope he did.
They have reserves. They have legal reserves ready for the lawsuit that's still pending with Bank of New York Mellon. So I'm not too concerned. I don't think the stock is, I think it's down today, but I don't think it's on this news. I think that's more macro. I'm not concerned if I'm a Bank of America shareholder about this.
Shorting Bank of America on this news?
No, I think, when you're looking at what news is, how news is going to hurt a company, it's all about expectations. What do investors think is going to happen? What are they expecting is going to happen? Bank of America has been sued, once a month for the past 6 years. This is not surprising to anyone, or should not be surprising to anyone. So just like we were talking about with QE earlier, these kind of news events should not be the kind of things that factor into people's judgments of should I invest in this company.
I think if you're looking at Bank of America, the thing you want to look at, if you're thinking about investing in it today, is what does the profitability look like in 5 years? Not what's this settlement going to be. That's much more important to the investment picture.
So here's something from out of the Wall Street Journal. The latest step forward. This is a quote from the article. The latest step forward in the Justice Department's ongoing efforts to hold accountable those who engage in fraudulent or irresponsible conduct. That's what Eric Holder said. I look back at this and it's like, I understand what they're doing, what they're trying to do, but at the same time, you've got a new CEO in at Bank of America. You've got a lot of turnover at Bank of America. You've probably had a ton of turnover with the investors that own Bank of America now. So who are you really punishing here? And I'm not saying that you don't do it. It's just kind of this funny place where they're trying to say we're holding somebody accountable. I think really what they're doing is trying to make themselves look like they're doing something. Mm-hmm. The Justice Department is trying to look like it's doing something. And in the end, if they can't actually hold somebody accountable that actually did something wrong, I don't know how much this actually accomplishes. If you're Angelo Mazzillo, if you're Ken Lewis, if you're the next Angelo Mazzillo or Ken Lewis, you're out there somewhere saying, what do I care? I can do all of this, I can take my bonuses, and then I can go off and play at Augusta for my retirement. They can't come after them.
When they were researching the financial crisis, they searched a lot of these bankers and traders' instant messages logs, and they found that during 2006, 2007, bankers were using a phrase IBG, YBG, which is I'll be gone and you'll be gone by the time the bill comes due for this. And that's exactly like you said now. You've had so much turnover, new CEOs at most of these companies, new employees, new shareholders. Who are you punishing here? I don't know if it really gets much done.
Press release from Freddie Mac. $5 billion in profit.
The gravy train that is Freddie Mac.
It is pretty incredible. And this comes just as President Obama jumps on the bandwagon to wind down both Fannie Mae and Freddie Mac. Mm-hmm. Should investors be celebrating? Should they be bailing? What in the world should investors be doing?
So a couple things. The $5 billion, it's great. It goes to the Treasury. It doesn't pay down any of that bailout money that they got. That's
part of the agreement, right?
Yeah, that's the new agreement that can't even pay that down. And the $5 billion, that could potentially be lower in future years. So there's talks of winding down that portfolio, which Freddie Mac makes a lot of its income off of. So when they're winding that portfolio down, that's going to lead to perhaps lower profits in the future. So all of that together, they're not going to be able to even pay back potentially. Even though they can't pay it back, they're not even going to reach that limit for potentially next couple years. Mm-hmm. I'm definitely not interested in buying the common shares of Freddie Mac or Fannie Mae. I know you share the same opinion. It's nice to see that they're not losing money. Mm-hmm. I guess you can say that as taxpayers because we're the ones who ultimately stand behind these institutions right now. So it's better than them losing $5 billion, but it's not a reason to celebrate as an investor.
Morgan, we've got the Corker-Warner bill out there. What Obama was talking about was essentially along the same lines as that.
Yep.
Are you confident that moving the government's involvement in that direction won't sort of pull the rug out from the housing market?
Well, I think if you look at other countries, how they do housing finance, they do things significantly different than we do in America. And do they have a terrible housing market with low home ownership rates? No. You have countries that don't have the equivalent of Fannie Mae or Freddie Mac, mm-hmm. don't have the deductibility of mortgage interest, that have higher home ownership rates than we do. I think it's very hard to change a system that is entrenched as it is in America. We've had Fannie and Freddie for half a century or more now, and people have come to rely so heavily on the fact that you can get a 30-year fixed rate interest with no pre-penalty, with no prepayment penalty, mm-hmm. At a low interest rate. You can get that whenever you need it. Other countries don't have that, but we're so used to it in America. I think it's going to be very difficult to pull that away. It benefits a lot of people, usually at the cost of taxpayers, which is a sort of hidden behind the curtain thing that people don't really see, even though it is a cost. And I think really the biggest cost that people don't see when we're talking about things like Fannie and Freddie and low interest rates and 30-year fixed rate mortgages is that those all in conjunction drive up the price of homes over time. You don't really see that. Mm-hmm. But that's the cost of these programs, is making home prices higher than they otherwise would be if we had a mortgage system like New Zealand or Australia or Canada, where you have variable rate mortgages, smaller mortgages, higher down payments. and in return have generally lower home prices in relation to income.
Sure, it's just like any other asset class, right? When the borrowing costs are low, the asset price goes up. So we're benefiting potentially from lower interest rates, but it just balances out in the end anyway because you're paying more for the house.
The housing bust that we had 2006 to 2010 really showed how entrenched housing is to the entire economy. When housing does poorly, everything does poorly. That wasn't true for, say, the dot-com bust in 2000. When you had the NASDAQ fall 50%, it stung a little bit, but life went on, the economy went on. When housing falls 30%, everything grinds to a halt. So I think when it's that important, it's really hard to change the system in any way that is going to affect housing prices, because that is almost guaranteeing that you're going to send the economy back into recession, which no sitting politician will ever do willingly.
Right, and I think when you look at what President Obama said, it really is keeping the front end exactly the way it is today. They don't want to change. They still want to have the 30-year fixed rate mortgage. What the plan is doing is reducing the chances of another taxpayer bailout. So it's basically moving the government further down the risk spectrum in terms of what are the chances that they're going to have to pay, and putting private capital for that first buffer. It's not said what that buffer would be. So we would wipe out private capital, then there would be the government reinsurance fund, and then there would be us as taxpayers standing at the end of the road if the world was ending and housing prices were down 15, 20%.
Although by doing that, wouldn't you, by definition, you would be raising the cost of capital by doing that? By some sense, if you're bringing in more private capital, that's going to take losses. It's going to raise the interest rates on those 30-year fixed rates.
Potentially, because you could argue without getting too accounting heavy here that if there's more competition in the marketplace, they could potentially price it correctly and lower than what Fannie and Freddie charge on their guarantee fees now. Maybe you could argue that.
Banks don't have any history with mispricing mortgage debt,
that's
do they?
the problem. So in theory, it could potentially stay the same, but in reality, it could potentially lead to a little bit higher rates.
Theory versus practice. But at the end of the day, doesn't it just make sense to have private investors taking losses when the housing market takes a dive like this?
Yes, I think if you're going to start a system from scratch, that's exactly how you'd do it. But I think it's so entrenched as it is now, it's just very difficult to move.
So you do it slowly. I mean, that's what I look at this as, is that it's kind of a slow movement towards a more ideal system, right?
I think the history of things like this moving slowly is pretty dim. When you're talking about something like this, you can either change it right after you have a crisis and change it immediately, or never. There's never going to be 10 years after a financial crisis, you're going to put in rules to prevent a similar financial crisis. You have about a year or two to put in these big bills.
So the housing market, as you mentioned, crucial to the economy. That leads us into our next segment, our special segment just for you, Morgan, Macro Vision. The economy is sort of slowly and steadily continuing to sort of improve. Nobody's really excited about it.
Yeah.
Nobody's really depressed about it, but nobody's excited about it. And now we've got the Fed kind of riling people up by saying that they're going to start pulling away accommodation. I'm an optimist, Morgan. I want to hear good news. I want you to tell me why I should be excited about this economy. And don't lie to me. Don't sugarcoat it, but make me happy.
Okay, so I'll start off by saying there is a website run by the Federal Reserve called FRED, Federal Reserve Economic Data. They have, I think, 60,000 variables on the economy that you can look up. Anything you can think of, the unemployment rate for people this age who live in this state, and all kinds of variables.
It is like an old school candy store for economic nerds.
Right, so 60,000 variables. How many of those variables do you think are truly important that actually tell you something that's going on in the economy that's important?
60,000?
Of those 60,000, I would say probably less than 5.
Okay.
Actually have meaningful data in there. And really, when you're looking at where the economy is going, what's going to happen next, first, we have a very poor history of forecasting what's going to happen next. But 2 variables that really matter is housing construction and auto sales. Those are what historically truly drive the economy going forward. So where do we say, right? So where do we stand today with housing construction and auto sales? Auto sales have bounced back to near where they were before the recession in 2007. They've come back extremely strong. You had a lot of pent-up demand from 2008, 2009, 2010, where auto sales just plunged. But cars were still getting old. People had to scrap cars. They were driving beaters. The average car on the road in 2011 was 11 years old, which is the highest it had ever been. So all that pent-up demand finally broke last year. Auto sales have rebounded. So we're doing very well there. The next is housing construction, which is really one of the main drivers of the economy. Right now, we're building about 900,000 homes per year. Over the long run through history, we usually need to build about 1.5 million to 2 million homes, new homes per year. We're building so few right now for a couple reasons. One, because we had this huge excess building last decade from the housing bubble. We were creating about 1 million households per year, but building 2 million homes per year, just because all the homes are going to speculators and people buying vacation homes and whatnot. All that excess supply and then some, I think, has really been soaked up over the past couple years. Housing construction fell to virtually zero when you factor in scrappage and whatnot. In 2009, 2010, it was virtually no net new homes being built. So you look at where we are today, building 900,000 homes. Just if you look at normal population growth over the next decade, we'll probably be needing to build, at some point in the next decade, 2 million homes.
Okay.
So double what we are right now. The question is, how fast do we get there? And will there be further shocks to the economy between now and whenever we get there? That's the unknown variable.
Okay, so hold that thought for just 1 second. Now, David, when you hear this, when you think about the doubling of the annual housing production, when you think about a recovery in the housing market, if that's going to happen, I'd ask you two things. First, we saw the Fed loan officer survey the other day, and what we saw were an easing on the commercial side of lending, but things have basically stayed the same, have stayed relatively tight on the residential side. So number one, what are the companies that you'd be looking at over the next 5 years as we think about these recoveries? And number two, do you think banks are still shell-shocked from what happened on the residential side, and that's what's holding this up? And is that going to recover over that 5 year period?
I think from the bank's perspective, what banks would I look at? I think when you talk about housing, it's the best move is to look regionally, because we talk about Wells Fargo and JP Morgan all the time. They're the two biggest originators, but the part of their business that's related to mortgage is relatively small just because they're such a diversified company. So I would look at regional banks and see, okay, which area of the country has a lot of runway for a lot of houses to be built. Where will that demand be coming? So I would look to the regional banks. And the second part of your question was what?
The second part of the question was basically, is the holdup with banks easing standards on residential loans, is that holding back the housing market, and will that change over the next 5 years?
It may be now. I think we talked about the pendulum swinging, so it was way too far to the risky side before the crash, and then it swung maybe a little bit too tight. And we said this isn't a pendulum that swings in 1 year cycles. This can be 5 year. He mentioned the next 10 years. It could be another 5 years before the banks really become comfortable to move further out on that risk spectrum. So I think it will slowly move back. I think the banks will be there if the credit standards are right and there's appetite for the loans. I just think we're not there yet. I think it will eventually get there, but these things are cycles. It's a credit cycle.
Sure.
And we're still not fully back up to a normalized.
I would also point out, there was a Wall Street Journal reporter who pointed out yesterday that as President Obama was giving his speech, more or less asking banks to loosen up their capital, Bank of America was
don't even get me started. Don't even get me started.
And look, I'm not questioning the Bank of America lawsuit, but there is a balance here of wanting banks to loosen up capital, but not wanting to repeat another financial crisis and making sure that some of the bad lending practices of last decade.
I think that's a good balance to strike. I think we can.
But it's hard to find that balance. Right. I think we're usually, like you said, it's a pendulum back and forth. It's hard to get that pendulum right in the middle. You're usually at one side or another.
So look, we're talking about 5 and 10 year periods here, or 5 and 10 year look aheads, and it sounds like the auto sales, which you said is very important, that's already come back. That sounds like a good thing. The home sales. And the housing construction still in the process of coming back. So when we think about 5 years out to 2018, 10 years out to 2023, we're 5 years in from the last downturn.
Yeah.
Do we get to that 5 year period or 10 year period without seeing some substantial downturn?
Well, look, so the last recession ended in June 2009. So, pretty much post World War II, the longest we've been without a recession is about 10 years. That's what happened in the 1990s. That was the longest it had ever been. The average post World War II cycle of recessions is 7 to 8 years. So the odds are very good. If you just look at it historically, anything could happen. We could break another record and go 12 years without a recession. But if you look at just the average, we will very likely have a recession before 2018, yes. So when we're talking about what's going to happen in the next 5 years or 10 years. There very likely will be, not only possible, but likely that we'll have more shocks, more recessions.
So now I'm keeping in mind that old joke of if you put your head in the refrigerator and your feet in the oven, on average, you're pretty warm, right? But when you think about those averages, I think a lot of investors think back to 2008 and 2009, and we think about, okay, we look ahead 5 years, we'll probably see a recession, or we might see a recession or a downturn within that time period. What's a reasonable type of recession? What's sort of an average type of recession to expect? Are we going to see 2008, 2009 again? Because like I said, I think that's what investors have in their head as in terms of this would be the next downturn.
Well, I think that's natural for people to think that. That's recency bias. If people take the last recession and assume that the next one will be just as bad, that very well might be the case. The next recession might be worse than 2008. I don't think it will, but it's possible. But the average recession over the past 100 years was significantly less bad than 2008. People should not, if we have another recession, it's entirely possible. There have been some recessions in the past that we didn't even know we were in a recession until it was already over, and most people didn't even realize we were in a recession when it was there.
I would vote for one of those.
That's what I'm looking forward to. I think if people go back and remember the 2001, 2002 recession, it was bad in the sense that the NASDAQ fell 50%, 70, 80%, whatever it was. And a lot of people lost a lot of money there. But in terms of unemployment, the unemployment rate ticked up from about 4.5 to 5.5 or 6%. So some people lost their jobs, but still the highest it ever got back then was 6% unemployment, which we would dream about today.
No double digits.
Nowhere close. We would dream about getting down to 6% unemployment today, whereas the last recession we got up to 6% unemployment.
Right, and you talk about recency bias. I think a lot of people are looking and saying, the banks are going to be the cause of the next recession because they were the cause of the last one. I think, in my opinion, the banks are not going to be the reason for the next recession. Their lending standards, as we said, are a lot higher than what they were. Their capital levels are almost double what they were before. So I think when you're trying to identify what's going to be the next driver of this recession, I don't think it's going to be the banks because that's the nature of kind of the financial shocks. They're not obvious. They're going to be things that we're not necessarily looking at today. As a bank investor, that's what we focus on a lot. I'm not really nervous that they're going to be the cause of it. Surely bank stocks could fall 50% with a recession, but I don't think they're going to be the ones holding the smoking gun, if you will, as much as they were. So
I'm gonna put you on the spot then, and I'm gonna say, looking ahead 5-10 years, with it in mind that we may see a recession in that time period, one stock that you're buying that you don't really care whether there's a recession or not, you're comfortable holding it through.
I'm a broken record. Got to go JP Morgan. I mean, I mentioned the regional banks. They're a little, obviously, more regional, more focused on certain areas of the country that more susceptible to downturns. JP Morgan, so many good businesses, certainly could be dragged down if the economy goes down, but JP Morgan's going to be around for the next 10, 15, 20, 25 years, and they're going to manage through these cycles, and I think they'll win in the end.
Morgan, agree, disagree?
I agree with that. I don't own shares of JP Morgan, but I've been buying shares in the last 6 months of Markel. And I try to keep my investment thesis pretty simple. So it's just a two-pillar approach here. One, I think it's the best run insurer, one of the best run insurers out there. And two, if you just look at the valuations of the insurance and the financial industry as a whole, they're fairly cheap. And the odds that sometime in the next decade or so, valuations of that industry will be substantially higher from here.
Great.
You're not getting off the hook here. You got to give us one.
Oh, I've got to give one too.
Don't say Berkshire.
I'm. You know what? I'm gonna say Berkshire. I mean, really, I agree with you on JP Morgan. Good ideas here all around. Berkshire Hathaway, such a great collection of businesses. Sadly, we can't expect Warren Buffett to be around for forever. When we look out 5 to 10 years, the guy seems like he's in not great physical shape. I mean, he's not running marathons, but very, very sharp still, on top of things, gets himself out there. But I think it's just such a strong business that with or without Buffett, it's well worth owning. So there's mine.
You actually did run a race with him recently.
I didn't run a race with him, but I was at the Berkshire Hathaway 5K as part of the annual meeting, and he was there at the beginning of the race. And I got my teen idol thing on, and I pushed my way over to the side when he came out, and I got a high five from Warren Buffett. So, for
not bad.
It was a pretty nice experience. We are now going to turn to a segment that we're calling You're the CEO. And we're going to look at a couple situations here, and I'm going to make both of you tell me what you would do if you were the CEO of these companies in this situation. And we'll start off with who else but Bank of America. So Bank of America, the lawsuits keep rolling in, David. Keep rolling in. We can't stop them. If you're Brian Moynihan at the top of Bank of America, how do you keep employees away from the windows and investors from hitting the sell button?
I think before you address those two, you have to go to your clients. He talks about we want to be a client-driven company. He says it over and over and over. I think you call your biggest clients and you walk them through he's walked everyone through his strategy, but make that individual connection. The bank is so big, I think they just have to get back to a little bit more of a personalized feel. And that comes from the clients, from the customers, but also do that with the employees. I think you just have to say, look, here's our vision. We're really sorry that we got into all this mess. But you guys are great employees. We want you to be here for the long haul. We believe that you guys are the employees that will carry us to the next stage. I think he needs to make that kind of statement, whether it's private in the company or comes out and publicly says, look, we got into a mess, but we really believe in our employees and they're going to get us over this hump and make us even more profitable for the next 5-10 years. That's what I would want to hear as an employee, as an investor, if I was a client. So I hope he's a little more warm and fuzzy than he normally is and just addresses it head on.
Morgan, or should I say Mr. Moynihan, what are you telling your client, your employees and your investors?
Well, I would add two things. I would say, one, I think Brian Moynihan is doing a better job at running Bank of America than most people give him credit to. It's an extremely large bank, and I think given that Bank of America's history was their poor history of poor deal making and poor lending was done at a time when Brian Moynihan was not the CEO, or at other companies that, at Countrywide, say. Mm-hmm. So I think what Brian Moynihan has done at Bank of America is better than most give him credit to. And just to go off what David was saying about your customers, I read an article about Jeff Bezos yesterday. Bezos is in the news a lot because he's bought the Washington Post. He was talking about at Amazon, what they do is they start by asking, what is good for our customers? Okay, let's do that, and we'll figure out how to make this work in the business, how to make it sustainable and profitable someday later. But let's start, the top of the pyramid is what is going to help our customers, and then you work your way down. Most businesses, I think, and banks too, do it the other way around, where it's what is profitable. Mm-hmm. Where are the big returns? Now let's figure out how we can get customers to want those products.
Right, and
so I think by flipping the pyramid like that is how you build a great business like Amazon has done.
And the reason banks don't do it, I think, is because they see themselves as so traditional. They have to answer to their investors. Oh, our investors will go crazy if we say that we're going to do something that's unprofitable for a couple years. But that goes back to I just think if a bank CEO came out and said, look, this is the approach we're taking. We are changing the way people do banking and the way banking stocks perform in the long run. We're going to really focus on the long-term profitability. I think that could be a successful thing. I don't know if one of them will do it, but I really think that is the way in the future.
I think I would point to two. When I was talking about Jeff Bezos, you look at Amazon. Look at how Wall Street values their stock. The company is almost run as a nonprofit. And Wall Street loves them consistently.
Because
so
he clearly communicates that's the strategy.
So taking the strategy of we're going to help our customers, we're not worried about short-term profits, we're going to build a long-term enduring franchise. Mm-hmm. That is a very pro-Wall Street movement, I think, as Amazon
I think we need to get Brian Moynihan on the phone and get you guys talking him into that customer-centric type of thinking, which to your point, David, he at least is talking about that. Mm-hmm. So hopefully that's coming through in the actions as well. Moving on to Wells Fargo. Wells Fargo inked a new deal with American Express. Wells Fargo will now be selling offering American Express cards to its customers. An interesting part of this is that only about a third of Wells Fargo customers have a Wells Fargo credit card. Now I'll start with you this time, Morgan. Post-credit crisis, in an era where people are worried about debt and credit, if you are John Stump sitting at the top of Wells Fargo, how do you want to get the message out to get your customers excited about another credit card?
Well, I'm a little bearish on the idea. I'll tell you why in a sec. But I would say, what sets Wells Fargo apart from other banks? It's one of, if not the best run large bank, is that they've been very good at cross-selling throughout the years, of selling multiple products to their customers. So I think Wells Fargo knows exactly what they're doing when they're bringing in new credit cards. I think they know exactly how to sell them to their customers, and I'm sure they'll be very successful doing it. In terms of just the credit card market in general, how do you set yourself apart? I'll just say from my experience, I really don't care whether my credit card says Visa or MasterCard or American Express. I just want a good credit card that what's most important to me is good rewards, good cash back, or good mileage. And I think in that sense, credit cards are very commoditized these days, and it's tough to set yourself apart without something like good reward. I mean, is that true for you guys as well? I really don't care. It takes 5 minutes to link your checking account to your credit card statement. It's really not that big a deal if you have multiple credit cards these days. And I'm just going to take the card that has the best rewards.
Well, I would say one of the biggest things too, and I don't want to bias you, David, before we get over to you, is I don't want to have to carry a whole bunch of credit cards, and I don't want to take a credit card out somewhere and have them say, "I'm sorry, we don't take that type of card here." And I'll tell you what, I think Amex is a well-run and good company, but when it comes to the cards, not everybody takes an Amex. So I don't carry an Amex. I carry a Visa because I always forget whether it's Visa or MasterCard that's everywhere I want to be.
Visa.
But in any case, Visa is everywhere I want to be, and that's why I carry that card. David, CEO of Wells Fargo now for the next minute or so, what are you doing to get your customers excited about this Amex card?
I just think you look at the credit card market in general, or the credit card business for these banks, a lot of them took their foot off the gas because a lot of them got burned really badly during the financial crisis. Bank of America really pulled back on credit card lending. JP Morgan not as much, Citi not as much, and Wells Fargo just slightly there. But I think if you're giving cards to good customers, it's an awesome business for the banks and the customers. We just talked about doing good business for your customers. Credit cards are great things for consumers if you pay them off. I mean, it's free money, free points, free travel. So it's a win for customers. It's a win for the banks because they get the interchange fees on those cards as well as annual fees on those cards. So it's a pretty profitable business when people do make their payments. Maybe some people miss their payments, pay a little bit interest. The banks like that a little bit. But I don't dislike the idea. It's not a huge game changer for them. But you mentioned you don't care about Amex. You don't care about Amex. Some people are diehard Amex people. I mean, there's a market out there, a high-end market. And we talk about these banks wanting to get high-end customers. This is a little bit of a different factor that they can tout out there. Bank of America doesn't have Amex cards, so they can say, "Hey, look, we cater to the 1%, for lack of better term."
So let's throw a little curveball in here to finish off this one then. This deal, Wells Fargo and Amex, better for Amex or better for Wells Fargo?
Wells Fargo.
I have nothing to add.
I don't. I'm an American Express shareholder, and I'm not super thrilled the fact that they're getting out of their. They hold everything in-house.
Right.
They handle the technology. They issue the cards. They issue the credit. So
you'd rather have them controlling the entire.
It makes me a little bit nervous that they're venturing out of their circle of competence. But I mean, American Express, they're a well-run company. I'll give them the benefit of the doubt that they know what they're doing. I'm not going to say that I know better than them, but it makes me a little nervous.
Okay, finishing off here, taper talk, taper tantrum, whatever you want to call it. The Fed's talking about tapering. The media's talking about tapering. You are now the CEO, and we'll say the Chief Investment Officer, of one of your favorites, David, in a holding of your portfolio, Annaly Capital. With all of this going on, how are you going to manage the portfolio? What are you going to do to look towards the end of 2013?
Well, when most mortgage REITs, some of their employees might be running around with their hair on fire. If I was the CEO of Annaly, I would say, calm down. The world is not going to end. We're going to manage through this taper tantrum, whatever it is. And I've always said, in the long run, once they weather the storm for their books, so rising interest rates hurts the securities on their books with Annaly. There's no way around that. That's what it is. But once they get through that initial weathering, and if there's a steeper yield curve, which in my opinion is likely, so if the Fed,
it's already steepening, right?
Right, and if the Fed tapers and the longer term interest rates tick up a little bit, I mean, I mentioned earlier in the show, they're going to keep short-term rates low, not necessarily through QE, but just through the Fed funds rate. So if there's a yield curve that it's very steep, the mortgage REITs benefit greatly from an income perspective in that scenario. So I would say calm down, We're going to see losses on our books, but we have a 20-year history of managing through these things, and we're going to win in the end.
So you play the survival game and last out until the business gets
Right,
a little
and
better.
if it means me cutting the dividend for a couple quarters, that's what you do.
You've got the buzzsaw out.
Yep.
Morgan?
I would just make a broader point that in all industries, there are a lot of CEOs and investment managers that look extremely talented when whatever the market they're in is in a broad upswing. They look like they're geniuses. But when you really find out how talented people are is when the market is crumbling. Not that the treasury market is that the mortgage market is crumbling right now. But that's
it's
true.
challenging.
That's true for Annaly. It's true for PIMCO right now. You're talking about Bill Gross, who has been the bond king for the past 20 years. Well, the bond market has been in the biggest bull market ever in the last 20 years. Now we're going to find out whether Bill Gross really is the bond king. And I think that's also true for a company like Annaly.
Well, you mentioned looking great during good times. Don't want to leave off American Capital Agency, one of Matt's ones that he likes to rag on a little bit. They came into existence, I think, in 2008, which for the agency mortgage-backed security market was a great time to get in. I mean, spreads were huge, values were rising over the time. So a company like American Capital Agency, they've really looked like all-stars for the last couple of years. The question for them is, can they manage through this? They don't have the history that they can point to, like Annaly does, that says, hey, look, we got through this in 2003 when interest rates spiked up real quick. So it'll be more interesting to watch American Capital Agency over the long term.
So what I'm hearing is David is going to buckle down as the CEO of Annaly, and Morgan is saying, I will believe it when I see it.
You got it.
All right, finishing off with Tweet It, the segment where we go through some of our favorite tweets of the past 24 hours, or last couple days, as the case may be. We're going to start off with a tweet from Cullen Roche, who writes, the land, I should say that his Twitter address is at Cullen Roche, CULLENROCHE. The land could be described as investment, but the house itself is a depreciating asset that will cost you a boatload to maintain. Morgan, I know this is a topic near and dear to your heart. What do you say?
Well, I think it's absolutely true, and you can look at the land as an investment, but a house is just a manufactured good made of wood and nails and metal and shingles, and it's going to depreciate over time.
Why
That's
do you have
just
to call it a
fact of
house? It's a home, right?
Okay, your home is just nails and wood, and it's going to depreciate over time. I think that's just an established fact. And if you look at over time, this is something we talk a lot about. Robert Shiller of Yale has looked at home prices adjusted for inflation since the 1800s. Over long periods of time, it's flat. And that's throughout the nation.
They're
of course.
cheaper today than in 1894.
Right. And real home prices were cheaper. And they might be different today because we've had a big run up, but at least last year they were cheaper. Real home prices were cheaper last year than they were in the 1970s. So, and that's, I think, what people should expect over time. I interviewed Robert Shiller 2 years ago, and I asked him, in fact, should people expect their home prices, that's all they should expect, is that home prices will go up with inflation and give them a place to live. And he said that might even be optimistic. There's evidence that over long periods of time, that real home prices will decline. Why is that? He said it's because a home is just a depreciating asset. Mm-hmm. It's just a pile of lumber that's going to rot, and you got to fix the roof, and you got to fix the plumbing, and fix the electricity. That's what a home is. I'm not,
stressing me out. You're stressing me out.
Of course, it gives you a place to live. And I don't own a home right now, but I certainly will when the time comes and I'm ready to settle down. I'm not anti-home ownership. I'm anti the idea that a home is a magical investment. And it's really interesting, even after the bubble. Fannie Mae has done some surveys after the housing bubble where they asked Americans, do you still think a home is a good investment? How much do you think your home is going to appreciate over time? People are still, I think, very much expecting too much of the housing market.
Does that ever go away? Do we ever get to a point where people don't expect that anymore?
If
you talk about recency bias earlier, people still have that idea of before the bubble, and now even just looking the last year or so with Case-Shiller up 12% year over year. So are we ever going to get to a point where people don't think that?
If you asked me 5 years ago, I would say once the housing bubble crumbles, people will stop thinking it. But they didn't. I mean, there's so much evidence that they didn't stop thinking that. So it's pretty interesting. It does make me wonder if we're in a new paradigm of housing. I hate to say that. It's the this time is different argument. It's terrible.
This time is always
But you
different.
look at how people are thinking about homes today, even after the biggest real estate crisis in 80 years. It's pretty shocking.
Yeah, I mean, I was talking to someone I know back home who's a young guy, and he said, well, I'm really buying this house as an investment. And I was just like, no, what are you doing?
It never ends, yeah.
All right, moving on to a tweet from Eddie Elfbein, whose Twitter address is @EddieElfbein. He writes, since June 2006, the U.S. economy has created 30,000 new jobs, roughly one for every 10,000 people. That doesn't seem like enough jobs, David. What do you think?
Not enough jobs. And when you see stuff like that, that's when people are like, market is so overvalued. This is not a great job environment. The market's at all-time highs. I don't get it. I'm going back to my point that the job market's not great. It's not great for the average Joe out there. But companies are in very healthy positions right now. Cash balances at all-time highs. So if you just look at the balance sheet of companies, revenue's not surging by any means on the whole for the economy. But the balance sheets, the strength of the companies are very strong right now. So that's why I think the stock market's at an all-time high. The question becomes, when is that not enough? When does the market start to expect the growth? And I don't know if we can predict an exact date when the market is kind of like, enough. We're expecting growth now, so I think that's why we're at all-time highs now.
When is that not enough, Morgan?
Well, I think to Eddie's point about jobs, I think there are a lot of stories about the economy that we exaggerate and overblow. I think jobs is not one of them. If there's a story that needs more attention that people should be worried about, it's the lack of jobs. And there are two types of jobs in particular. Jobs for recent grads or recent high school grads or recent college grads, and the long-term employed, the long-term unemployed. There's an economist from Yale named Lisa Kahn who's done a lot of work on this, and she shows that if you graduate from college when the economy is weak and unemployment is high, that sticks with you for life. And you can measure people 15, 20 years after they graduate. They're still earning less money than their cohorts were that graduated when the economy is strong. It's also true for people that lose a job in their 40s and 50s and stay unemployed because the economy is weak like it is now. That can take forever to recover from. You can effectively never recover from that. There's an economist from Columbia named Till Von Walker who's actually showed that losing your job during a deep recession lowers your life expectancy by 1.5 years, just because of the stress and everything. It's terrible to talk about. I don't want to make people too gloomy, but I think if there's one story that is extremely direly serious in the economy, it's that tweet that Eddie pointed out of how few jobs there are today.
Way to go. Now I'm depressed, Morgan. To finish off and to on a happy note, because this is my favorite of the three by far, Barry Ritholtz, whose Twitter address is @Ritholtz, that's RITHOLTZ, writes, there are more hedge funds in the U.S. than there are Taco Bells. That tickles me, but also makes me sad at the same time, since I love Taco Bell. What's going on here?
You know, it used to be 30 years ago, even 20 years ago, there were literally a handful of hedge funds. People like George Soros and James Simons and even Buffett back in the day before he bought Berkshire Hathaway. And it was such a small group of investors that they really could exploit these inefficiencies in the market, and they could earn consistently higher returns. In the past decade, and it has just been in the past decade, there's been such an enormous explosion of hedge funds, and now every Joe Blow has a hedge fund run out of their mother's garage that they raised $10,000 from someone. It's become so common these days that the overall returns of the hedge fund industry are abysmal, which is exactly what you'd expect. Their goal is to beat the market. That's most of their goal anyways.
It should be.
But they effectively are the market right now. There's so many of them. You know, there's I think more than maybe $3 trillion in the hedge fund world right now. So it's mathematically impossible for all of them to beat the market. So there's going to be a lot of disappointment, which is what there is.
David, have you opened up your hedge fund yet?
Not quite. It's still, the paperwork is still going through.
The paperwork.
I don't know. If you're a person out there that is an accredited investor, so you have, $1 million is that the limit to invest in a hedge fund, I would just be very cautious. I'm not saying all hedge funds are bad. That's certainly not true. Some hedge funds are really great for their investors. They make a lot of returns for them over the long haul. But if you're interested, just really know what you're getting into and take that to a financial advisor if you have one. Take it to a couple other parties to have them look at that fund, at the performance. Make sure you're not missing anything before you commit to some of these
I'd say it's really true too. I think there are about 10,000 hedge funds or thereabouts in the United States, 8,000, something like that. There are probably about 100 that are extremely talented, legitimately talented investors that will earn high returns over time. By and large, those people do not want your money and will not take your money. They're either not raising any more money, or if they are, they're not going to individuals. They're going to sovereign wealth funds and pension funds. So by and large, the really good, talented hedge funds you can invest in.
So what I'm hearing from both of you, Taco Bell better than hedge funds. And we can end on that note. For Morgan Housel and David Hanson, I'm Matt Koppenheffer. Thanks for joining us, folks. We'll see you tomorrow.